The Atlanta Fed now estimating third quarter growth at a vigorous 3.2%, while investors weigh data from two key inflation reports out this week. Both producer and consumer prices for September coming in higher than expected. What does it all mean for the growth of the U.S. economy and financial markets? Here to take it up with us is Apollo Global Management Chief Economist Torsten Slok. Torsten, great to see you again.
Thanks. Great to see you, Jack.
So back when everyone was worried about recession, you were saying, hey, the economy's actually not slowing down. The Fed should not cut aggressively. Your predictions proved accurate. But you're still saying that investors may be hoping for more cuts than conditions warrant. You recently published some charts backing that up. We're going to show them. Tell us what's going on in the economy in your view.
Well, the economy is doing just fine. If you look at a broad range of indicators, everything from how many people travel on airplanes is still strong. If you look at wage inflation, which is what you see in the chart here, that's still relatively strong. If you look across the board at how many people go to restaurants, if you look at consumption, if you look at production, and if you also look at even how many people go to Broadway shows, this is a weekly indicator that is publicly available also. That's also suggesting that even discretionary items, a Broadway show can be a little bit expensive, up to $200. People are still spending. So broadly speaking, Jack, the bottom line is that the economy is actually still doing just fine.
So what is the Fed's proper playbook in that situation?
Well, the Fed obviously in September lowered interest rates, but of course the Federal Reserve has a dual mandate. One is that inflation should be 2%, and inflation has come down from 9% in 2022 to now around 2.5%. So we are almost there, and we have come a very long way. This was used as a main reason why they did lower interest rates. But the other side of the dual mandate, namely the economy and most importantly full employment, we still have strong job growth. We saw last week 254,000 jobs created in the month of September. The unemployment rate is falling. Wage growth is still strong. So on that side, the economy is still chugging along very nicely. So it really is only one side of the dual mandate, namely inflation has come down. And that was used as a reason for cutting. But we do still think that the Fed is probably going to continue to cut, but cut much less than what the market currently is pricing.
Alrighty. So another sort of key part of inflation, of course, is energy prices. And you recently published a really interesting chart that for the first time, energy supply was exceeding demand. We're pumping more oil than we're using. Could you explain what the implications are for the economy, for inflation, and also is all this data center need for energy going to end up sucking up that supply and demanding more?
Absolutely, and this is a very important development in the last few years. As this chart is showing, that we used to have that the amount of energy produced in the US was lower than the amount of energy consumed. But that has now changed around because the US has now ultimately become an energy exporter and producing more energy than we consume in the US. So that means that the supply of energy on its own would of course argue for some downward pressure on oil prices. But now, of course, we are having the challenges in the Middle East, and therefore there's now more uncertainty about geopolitical risk, and that has, here in the short term, been putting some upward pressure on oil prices. So there's a tug of war going on in energy markets, and if we do have more geopolitical uncertainty, that could, of course, become an issue for the Fed, because then not only the strong economy would put upward pressure on inflation, but also energy prices would also be putting upward pressure on inflation.
Sure. Another interesting economic wild card right now is productivity. For a long time, productivity gains were awfully sluggish. Recently, we've seen a little bit of pickup. People are wondering, is that just temporary? Is that going to endure? And you sent around an interesting study by an economist who said that the working from home phenomenon was actually helping productivity. I know a lot of us think people got to get back in the office. They're not being as productive. Maybe that's not true.
Yeah, no, Nick Bloom from Stanford University just put out this very interesting study where he looked at, are people more productive when they're working from home? He has found that we have now seen a stabilization, that people spend 25% of their working hours through a week at home. So that means a little bit more than a day relative to in 2019, where it was essentially zero. And there's been a lot of discussion about, is this good for productivity? Is this bad for productivity? But what he found, and what makes a lot of sense, is that people are actually more productive when they work from home. And that's why this productivity gain, exactly as you're saying, that we have seen, it is a bit of a wild card, as you're also mentioning, because that could potentially be something that could make a difference now that we have this more permanent feature of more people working from home.
Alrighty, we are out of time, but in one sentence, can you give us your best investment idea based on all the economic stuff you're seeing?
Yeah, so that's very important, Jack. So because the economy is still doing very well, we do not think the Fed will be cutting rates much, and therefore interest rates are going to stay higher for longer. Therefore, private credit and fixed income more broadly is going to give yields that are generally higher than what we saw from 2008 to 2022. So fixed income, private credit, yield levels are going to remain very attractive.
Torsten Slok, thank you so much for your insights. We always appreciate it. Good luck to your wife in the Chicago Marathon.
Thank you so much.